It's Fed Week, and we have Frank Holmes with us this Monday. Frank, thanks for joining us from sunny Florida.
It's good to be talking to you. It's cool down here, but it's beautiful and sunny.
Well, I'm sure it's still much warmer than up here, Frank. Let's look at the gold market now. Now, since the last time we spoke, a lot has happened. We had the ECB announcement, which really helped to move gold prices. And the latest news, the Greek election over the weekend. What do you make of the results? And can this add to the uncertainty we're seeing in Europe?
Well, I think the first thing starting for this year is what Switzerland did. And it was just unexpected that the Swiss bank would have a major economic policy change, not just on the weekend, but through the middle of the week and catch everyone off guard. Now that creates uncertainty because so many banks and financiers are leveraged against the currency and it becomes disruptive. Now Greece has more uncertainty to the overall EU, and the EU currency itself is going to falling last week and last year. So I think the big thing for investors to recognize, when you look at the G7 or even the G10 countries, the only country that's giving you a high rate of return is the US dollar. And when everyone else has negative rates of return, gold, like last year, became the second best performing currency. And I think you're going to see that this year.
Let's get to our OT segment now, opportunities and threats in the gold market. Starting with opportunities, gold hitting 1,300 last week. Now, it is unable and was unable to hold these gains, but having reached that 1,300 level, Frank, was that a game changer for gold?
Well, I think that some of the great forecasters, gentleman out of the UK, has been number one for 5 years, and he's calling just over 1,300 for the year. You know, the DNA of volatility for gold, it's a non-event to go $150 up or down. That's just normal breathing. Now, for gold to run up $300, that would be significant over the next 12 months. So I think when we look back from a month ago, where gold is today, it's just as normal DNA of volatility. But what's driving it are the uncertainty of the euro and negative real interest rates.
Frank, we're also seeing physically backed ETPs set to mark their strongest months since September 2012. Is that a sign that things are changing?
I think the sentiment changed in the first week of January when you saw gold and all the gold stocks break through their 50-day moving average.
Frank, on to another opportunity. We have the Chinese New Year set to begin in February. Could this help support gold prices?
Yes, I think with the oil falling, like I've mentioned, that's a $500 billion global peace dividend, $500 billion. It has a massive impact on countries like India, and it truly helps their trade deficits. The other factor was hurting them was consumption of gold and high oil prices. Now they get a big break in oil prices. Maybe the government's going to drop some of the tariffs on gold coming into India. And so we could see a second wave in the next quarter of huge consumption of gold for that love trade in India.
Moving on to threats for the gold market, Frank, I have just one for you this week, and it's the biggest one. It's the FOMC. Could it be a game changer for gold? Could it hurt gold prices?
No, I don't think so. I think that we're in a secular bear market for interest rates, that is living with low interest rates, because the fiscal drag is so great. All the rules and regulations in Europe and America are still have policies of adding more layers to them. So any spike or any rise in interest rates will be very unsettling to the housing market. And I think this fall in oil, we're going to see this quarter even greater number of write-downs and capex declines in the infrastructure for oil and gas. And that will have an impact on jobs. So I don't see rates rising.
Well, that's interesting, Frank, because many analysts I spoke to said that since QE has been announced in Europe, the Fed has its hands tied now and can't really do much.
Well, they don't have to because they already have the highest rates. That's the interesting part. You know, even a 5-year, which is negative, and a 10-year, which is below the average dividend of the S&P 500, it doesn't matter because the rates everywhere else are zero to negative.
All right, let's wrap with gold's touchdown pass of the week. Is it the uncertainty that continues in Europe?
I think that that's what's going to continue to be the unsettling factor. But I would look for the rise of emerging markets doing much better over the next 6 months with oil prices off 50%. It will show up in their economic activity, and that will lead to the love trade of greater consumption of gold. The other thing to remember is Russia. Russia's the wild card here, and it could be the black swan. And they continue to buy gold while their currency is being devalued. So I think that we just don't know, but I think that you have to look at it mathematically as they could be the black swan.
All right, Frank, thanks so much. We'll see you next week.
Take care.
And thanks for watching Gold Game Film with Frank Holmes. We'll see you on Tuesday.